Now what that means is that the chart shows me 20 days of economic activity within the stock market. Each individual candlestick represents 1 hour of market activity, right? So 20 days of market activity, each candlestick 1 hour of market activity. Now let's say I change this, I'm a day trader. I change my approach to a 1 day, 1 minute chart. Now each individual candlestick is 1 minute. It represents 1 minute of market activity, each increase and or decrease, right? And the entire thing, the entire graph here, or chart, depicts 1 day of market activity, right? So it changes the statistical indicator that I'm using. If I'm a day trader, I might open up my 1 day, 1 minute chart. Actions within 1 minute are much more volatile than what happens over years, obviously. If I have a chart that shows me 20 years of economic activity in a certain stock, right, each candlestick might be, 6 months, we're representing 6 months of market activity. So it changes how I interpret that graph and how I use my technical strategies. Right. Now, ask and bid price. Ask and bid price are the two different orders that you put in when you're going to buy or sell a stock. So you'll see right here when I hover over bid, right, it pops up and it says sell. If I want to sell a stock, I own some kind of financial instrument. I own 20 shares of Amazon. When I want to sell my Amazon shares, what's most relevant is what the bid price is at that given point in time, right? If the bid price, such as in this example right here, is 148.16, right? That means that if I am to sell right now, I'm most likely going to get filled at that price. The ask price, on the other hand, is the buy price. It is what people who are going to buy the stock are willing and able to pay for the stock, right? So if I'm going to buy it, I'm probably going to have to buy it for a little bit more than the price I could possibly sell it for. So in this case, 148.71 just changed to 148.89 because this is active. But there's a margin in between there. I might have, an ask price of 150, a bid price of 150 and an ask price of 152. And I have that $2 spread, right? That is called spread, right? And it means I could get filled if I were to buy or sell a stock anywhere within that range. And there's sometimes it gets dangerous, right? Where you could have a spread for a penny stock, for instance, where the spread is anywhere from 1 cent to 5 cents, right? That's a huge spread. The stock is worth 1 cent or possibly 5 cents. That's a 500% difference in my potential purchase price there and where I could possibly sell. So it's important to understand these two prices. At a base level, though, where you buy or where you sell is going to be about halfway between those two values. In most big volume stocks, obviously if you're trading something like Amazon, Apple, Microsoft, you'll get a perfect price in between those two, right? Because they're much more secure. So it's important to understand, the most important thing to understand, I think, for trading is this notion of support and resistance. It applies to literally everything, every technical trading strategy you could use, every trading approach you take. But in order to understand support and resistance, you need to know what critical support and resistance is, right? And it's this notion of, if I have an analogy that's the best to explain it, there's a floor beneath me, right? And there's a ceiling above me. It's incredibly similar to supply-demand economics, right? There's a floor beneath me and there's a ceiling above me. It is incredibly unlikely. I can reasonably assume that if I am to take my next step, I'm not going to go burrowing through the floor, right? Whereas I can also reasonably assume if I take my next step, I'm not going to shoot up through the ceiling, right? Most stocks have what is called long periods of consolidation, right? Consolidation is where I have a support level, right, as depicted here, and I have a resistance level. And the stock price remains very stringent in this area. This could represent, for instance, let's say 3 years of activity for some kind of a corporation. Let's say it's like Intel, for instance. 3 years I've been between this area of common support and resistance level. Right here at the support level, I have a concentration of demand, meaning that there's not enough demand to justify it going beneath that price. And at the resistance level is a concentration of supply. It's resistance level, I'm not going to break through that common supply level. But if something were to happen with the stock, let's say it's a pharmaceutical company, and it gets FDA approved. They have some drug, it's an important drug, gets FDA approved. It's no longer reflecting common market activity, right? Because an FDA approval just happened. So what's likely to happen is that the stock is going to break through its resistance level and continue to go up, right? If you break through a common support resistance level, you are likely to see a significant uptrend or downtrend. Obviously a significant uptrend when you break through resistance, and a downtrend when you break through support, right? So in this example, this could be like a negative earnings report. Amazon had an earnings report, it was not good. They were, let's say, 10% beneath their projected sales target, right? Or profitability index. That's horrible, right? And people would begin to sell off that stock. Right here, when I break through my support level, I would have a new idea. I would have an indication, that the stock price was going to go down, right? And it would likely go down in a significant fashion over time, right? And then right here, this could be the beginning of a new support resistance level. Right? But that is what you need to understand when you're dealing especially with big market companies, Amazon, Intel, whatever it just might be. It's not as relevant when it comes to penny stocks, of course, because they don't consolidate for so long. They're literally everywhere. You never know where they're going to be. They're much more volatile. Now, we're not going to say that you should make a decision just based off support and resistance, but it's important to understand you're looking at it. So Nick, this is an example that he pulled up right here.
Absolutely. So this is a Tesla chart, and this represents three years of market activity. So this is way back, back in 2016. And as you can see, at multiple times, it tried to break above this level, which it hit a high of 389. So I'm guessing this level is at about 388 or something like that. It bounces off of this level initially, and then when it comes back up, it might break out of it again, right? And then it crushes back down. So then you've confirmed that area right there, that 388 or whatever it is an area of resistance, right? Because it tries to test it again, and then it bounces back down. Then test it again, bounce back down. Test it over here, and then bounces back down, right? Conversely, along this chart, as you got a little bit more recently, you can see that it bounces off this level of support, right? Because when it comes back to that level, whatever that may be, I think it's like 330 or something like that, it bounces back off. And then once it finally breaks that trend, right, then it bounces back down. That's comes way back down. That's a significant downtrend.
This downtrend right here is roughly 30%. It's roughly a 30% decline, right? Which, for trading standards, that's a shorting position, right? Well, I've broken through my critical support level, which has existed for roughly, let's say 2 full economic years here. When I break through that critical support level, that's an indication of its downtrend. Over the next number of weeks, months, this decreases by roughly 20 to 30%. Right? Hey, how are you?
Sorry, Mike.
No, it's okay. That would be a shorting position, right? So obviously the inverse is true. If you were to go above your resistance level, that would be a buy-in position. Well, if something good has happened in the market, there's likely to be a breakthrough into a new support and resistance level. This is time to buy. So support and resistance more generally, right? We just talked about critical support and resistance. And then you hear support and resistance, you're like, what's the same damn thing? It's really not. It's a little bit different. And it appears differently on every technical strategy you use. Right? We're going to talk about 4 technical strategies today. And support and resistance will appear different on every single one of those charts. And it's important to know that it's still there. You just need to know how to read it, right? And once you understand it, it's very easy to see. So like I said, it's essential when using technical strategies. Every technical strategy is support and resistance. It always signals points in which you should hypothetically buy or hypothetically sell a stock. And it suggests a new channel for price direction, right? Now what I mean by that, and I think a very good example to talk about it is right here. It's SMA, or simple moving average. We're going to define that later for people who don't know what it is, right? But just know that this line is my support resistance level, the blue line right here. The yellow line is an exponential moving average. But let's just focus on the blue line, my simple moving average. When I'm beneath my simple moving average, which is my line of support and resistance, I'm in an area of resistance, right? Meaning